If you've been doing research on YouTube, looking into index universal life insurance for cash value growth and future income, and you've come across a bunch of conflicting information, I want to promise you that you are in the right place. We're going to try to make this really super simple and easy. We're in the last installment of our series on what makes a good indexed universal life insurance policy, and we've really saved the best for last. You can make sure that the last 4 topics we've covered are in line and in check, and you've chosen a good policy based on all the different parameters that we just discussed in our previous videos. And if you get this one thing wrong, you're not going to be happy with the end result. So today we're talking about the most important thing when it comes to index universal life insurance, and really we could expand that to just saying cash value life insurance. So if you're looking at cash value life insurance, that is a non-term insurance contract, and you're looking at it in order to stash away money to accumulate dollars on a tax-deferred basis and then hopefully withdraw those dollars or loan those dollars out tax-free in the future, the number one most important thing that you have to get right is the design of the product. Now, the reason that you have to get the design of the product right from day one, from the get-go, is the largest fees on the policy are all going to be based on the initial design. If you get into a policy and you realize that it was done incorrectly 2, 3, 4, 5 years down the road, the opportunity that you have to kind of rectify the situation or improve the policy that you already have purchased, it's actually not that good. There's not much you can do to a policy once it's already been issued, because most of the fees, the majority of the fees, and I'll just say the largest fee on the policy in most cases, is going to be based on the initial design, whether or not you change the design later. So you got to get it right out of the gate. So I'm going to show you some examples of 3 different policies. 2 of them are designed poorly. 1 of them is designed the right way. These are policies that we did here in-house just so that you can see it as a sample. And we structured it the way that we would see bad policies come to us. So when people book a discovery call with us and they want us to review a policy, these are 3 of like the common errors, or I guess 2 common errors that we see, and then we'll show you the right way to do it. So the first one is this. You'll see that we've got a pretty big premium here on this particular contract, $83,000 per year, going into this policy for 12 policy years. And if we look at the income that's being generated on this, we're generating $95,000 a year, tax-free for life, with no market risk. And what happens, unfortunately, is a lot of people will see projections like this, and they will see one option, and that one option will look good. I mean, on the face of it, 12 payments of $83,000, and then you get to take as many payments as you can until you pass away of $95,000. It's tax-free. There's no market risk. On the face of it, I can see how someone would see this and say, hey, this looks pretty good. Let's start the ball rolling on this process. I like it. And what's unfortunate is most people just don't know the questions to ask. So what are the problems here? Well, number one, the problem is this initial death benefit of $2.8 million. By the way, this is a 47-year-old male preferred non-tobacco, in case you care. And this is a Symetra policy, which really doesn't matter. The point of this video has nothing to do with the company that you use, everything to do with the design. But nevertheless, it is a Symetra policy. The issue here is this death benefit's way too large. I mean, this is way too high of a death benefit given the premium that this particular client is paying. So here's where everything starts to actually get explained on how we know that this is just not a great design. We've got our premium going in. Again, it's $83,000. And when we look at this policy, we've got these numbers here, this guideline premium test and this MEC status. So $83,000 per year is going in, and yet the IRS would consider the maximum premium on this policy to be $218,000 a year if you're paying basically 4 years. If you're going to pay for longer than 4 years, which we are here, this is a 12 pay, the maximum premium we can pay on a yearly basis is $193,000 per year. So we have woefully underfunded this particular contract. Another way to say that would be, we don't need this much death benefit in order to house our $83,000 in premium. And if we don't need that much death benefit, it means we're paying fees that we don't need to be paying if the goal is maximum cash and income. So that's the first thing. We know that this death benefit is way too high for this particular premium. So the second thing that's wrong with this policy is it has an increasing death benefit. Now, if you've been watching this channel for any length of time, you will actually have heard me say that you should almost always have an increasing death benefit. And that's true if you're doing things the right way. Unfortunately, there's a lot of insurance agents out there that watch my channel, and they watch my channel to kind of get trained and educated, but they're not so much concerned about doing what's right for the client. So they'll hear me say things like, you should have an increasing death benefit. And so what they'll do is they'll write a policy like this one, where the death benefit is too high relative to the premium being paid, 2.8 over 83. We just talked about that. That's too high. And so what they'll do to avoid any, or rather maybe to try to do things in a way that the client thinks they're doing it the right way, they'll tack on an increasing death benefit. And so that's what we've done on this policy. We see this all the time. Not only is the death benefit too high to start with, but they've also added an increasing death benefit. And you can see that every single year, our 2.8 goes to 2.9, 2.98, 3, 3.1, so on and so forth. Well, an increasing death benefit is awesome if you've designed the policy the right way. If you've designed the policy with a death benefit that's too high from the start, tacking on an increasing death benefit actually makes the policy much worse. Let me prove it to you. So here's our initial policy, 83 and 95, with an increasing death benefit. So all we did is we reran this policy with the same initial wrong, and by wrong I mean too high. So we still kept the death benefit too high to start with, but we took off the increasing provision from the contract, and what we're left with is a level policy. And with a level policy, it's actually pretty interesting that the policy is much better. I mean, I'm not surprised that it's better because I knew that it would be, but here's our 83 going in. It's our same $2.08 million in death benefit, but our death benefit is level, not increasing. And so, if you come onto my channel and you hear me say you should always have an increasing death benefit, and then you go out and you choose to work with somebody who's not really doing things on the up and up, they might just tack on an increasing death benefit to a poorly designed policy and say everything's good. That's not the case. Here's our $2.8 million policy with a level death benefit, and our income is 102. So on the previous example, I think our income was 90 some, and we're all the way up to 102 just by taking off that increasing death benefit. It makes the policy cheaper. So those are two wrong ways to design a policy. Number one, too much death benefit up front. Number two, making it even worse by adding too much death benefit up front and tacking on an increasing provision to the contract. The best way to do it? Well, let me show you. This is the best way to design a policy if your goal is maximum cash and income. You're going to have your same $83,000 premium for the same 12 years. And what we've done on this particular contract is we've got a $1.2 million death benefit, and it's an increasing death benefit policy. So we've axed out about $1.6 million of death benefit. We've taken off $1.6 million in death benefit, 2.8 to 1.2. More than half of the fees have been taken out of this contract. It is an increasing death benefit provision until we stop paying premiums here and we switch to a level policy, and our income is up to $114,000 a year, tax-free with no market risk. In that 35th year, we've got $756,000 left over in cash. Now, if we compare that to the other design that we just looked at, the best of the two designs was that level policy, $102,000 a year in income and $674,000 left in cash. I mean, it's just so much better. In every way, it's better, unless what you want is more death benefit. And I would submit to you that this is actually the wrong way to get more death benefit, because if you want more death benefit, most people that we talk to want more death benefit in these years here, leading up to retirement. Once they get into retirement, most people don't have kids in the house. They don't have the same level of debt that they had when they were in accumulation mode. And so the death benefit need dwindles as you get to and into retirement. And because of that, that's the perfect scenario for term insurance. So what I would tell you is, if you want a policy to build cash and income and be designed the right way, be as efficient as possible, and give you the best opportunity for the policy that you purchase to do what you want it to do, the only way that you should ever be designing these policies is by minimizing the death benefit, using an increasing death benefit, paying the maximum premium, and getting yourself into a situation where that starting death benefit is as low as humanly possible. And here, I'll show you what I mean. So here's our MEC provisions. Our 7 pay, so if we're paying 4 premiums or less, thereabouts, our maximum premium is 94. If we're gonna pay more than 4 premiums, and we're paying 12 in this case, what's our maximum premium? 833, 333. We have maximum funded this thing to the most level that we possibly can. I mean, we're sitting at a premium of 83,333, which is exactly the guideline annual premium. So this is the way to do it. And if you need more death benefit, what do? You can buy a term policy that's dirt cheap for however many years you're going to need it, but I would be willing to bet you're not going to need that death benefit forever. And you'd much rather have a policy that's designed for maximum cash and income, and supplement that with a cheap term insurance policy that goes away once you do get to retirement, because in the end, it's going to generate more income, it's going to have more cash, it's going to be safer, and you're not going to have to rely on the market to perform as well in order for the illustration, or rather in order for the policy to match or keep up with the illustration that you've seen. Hey, I know these things can get complicated. You know, we're 5 videos deep now. We're just now talking about how to design the policy, and there's a lot more detail that we could go into here. But the reality is, every single one of you is different. You all have different goals. This may be a perfect fit for you. It may be a terrible fit for you. It all depends on what you're trying to do. And so if you're curious about index universal life insurance, if you're curious about using cash value life insurance for supplemental retirement income, I would tell you that you probably need to have a conversation with us. And I promise you this, we're going to shoot you straight. We will let you know, hey, this is a good fit or it's not a good fit. And we do about 500 plus policy reviews every single year. We've saved over $60 million in lifetime fees of people who choose to actually do business with us. So they come to us with a policy that's designed poorly. We fix it. We've totaled up those fees that we've saved over the last several years. It's over $60 million. We've increased income distributions by over $40 million in lifetime income distributions. We know what we're doing. This is a safe place for you to explore this as a potential alternative to just putting all of your money into the stock market. So if that's a conversation that you want to have, I encourage you to check out our website, leveragewm.com. You can check out the description below. We'll put a link there where you can book a discovery call with us and just start the process on opening up a dialogue, asking some questions, and we'll come back to you and we'll let you know, hey, this is either going to work for your situation or it's not. But you should know our goal here is not to sell you a policy. Our goal here is to arm you with enough information and education to get you to a point where you feel comfortable making a decision for yourself and you feel good about the decision that you're making. If we can get you to that point, we win no matter what you decide to do. And that's the whole goal of our discovery call process. So if that sounds interesting, if that's something you want to explore, you can click the call out card above. You can go to our website, leveragewm.com/IUL-review, and we will talk to you there. Until next time, take care.